Hello, this is Joe Mass, and I'm ready to give you another market review. Unlike some market reviews I've done in the past, this one's going to be a little bit different because there's so much uncertainty going on right now. I'm not going to run you through a lot of the technical charts and the details and all the numbers because everything is in flux, and we just have to wait and see. So I'm gonna give you a quick review, talk about the tariffs, talk about recessions, talk about most importantly, what we're doing and what you can do. So let's get started and try to have some fun. As I'm starting to record this, it is Sunday night. The futures markets are down. They've been bouncing around over the weekend here. They've opened back up on Sunday night, and they are definitely down. So it's looking like Monday's going to open as a down day. Asia has been down. The 10-year bond is at 3.9. Oil's just plunged down to 60. And so, there's definitely some uncertainty and volatility going on in the markets. And so let's see if we can't break some of that down. First of all, what I'm going to do is talk about what we do and how we are following our processes. Because, if somebody doesn't want to watch the entire video, this is going to be the most important part that you probably want to listen to. So I thought I'd start with that and not bury the byline. Okay, so our strategy. We've raised some cash in our tactical portfolios. So our focused tactical equity is close to 30%. We've had some cash coming into last week, and we raised some more last week. We've also shorted the market, which means making, betting against the market, and you can make money when it goes down. And so in the appropriate portfolios, we have shorted the market. We'd put a short on a few weeks ago. We took it off. It's back on, as well as raising some cash. So again, as an active tactical manager, we're making adjustments as we get new news and new data when we digest that, okay? And we will continue to do that. Now, our risk-off strategies are holding up very well. So individual bonds like the focus bonds, the Synergy Asset Management T-bill model, those are doing very well. They're fixed income. There's a lot of certainty in there, and those are protecting the portfolios. Asset allocation models, they're also doing very well. And again, one thing to remember with asset allocation is asset allocation doesn't mean that you can't be down or that you're going to beat the market, but asset allocation, if done properly, means that you're down considerably less than the general market. Okay, so again, the asset allocation models, we have a few of them that are barely positive for the year. Most of them are negative, but again, down considerably less than the stock market, 40, 50, 60% or more less than the market. Now, the dividend and value portfolios are holding up very well, better than the broader market. So again, we've been seeing a big rotation, as we've been talking all year, from the growth and tech stocks into more dividend and high quality and recession proof stocks. And so the dividend portfolio is actually still positive as of last Friday. So again, being positive is good in an equity portfolio, and we expect dividends and value to fare better through these periods of uncertainty. Even though they may actually go negative for the year, they're going to hold up better than the broader market if volatility and uncertainty remains. Now, we believe that our risk on equity strategies are holding up well relative to the benchmark. So again, our risk on equities are doing better than their benchmarks, and that's what we look for as a manager, right? We're looking for something that we're managing is doing better relative than its measuring stick. And so those are working. So all of our portfolios are working. That doesn't mean that they're up. It just means that they're doing what they're supposed to be doing, and we'll continue to manage those and make adjustments as necessary. So again, diversified portfolios may reduce the tariff exposure. We're going to talk more about that in a few minutes. Okay, now again, we've weathered this volatility before. I've been doing this for 30 years, and I've been here before. I've seen this before. I'm not panicked. For most everyone that we're working with, they're well diversified. They have a great mix of assets. Okay, they have their parachute before they need it. And so, that short-term volatility doesn't derail our long-term goals, right? And that's one thing that we've learned over the last 30 years and how we can maintain our calmness as a professional, fiduciary and institutional investor during these difficult times. And again, it's also really important to remember that opportunities may emerge in this disruption, right? And so we believe that we're positioned well to seize those and to adjust the portfolios to find the bright spots. And again, we'll talk more about that here in a few slides. So what we do, we listen to you and adjust portfolio allocations as you direct. We manage cautiously, we monitor and adjust, and we communicate. Okay, now I want to go back to this listen to you and adjust portfolio allocations. So we're going to automatically adjust the stocks and bonds and ETFs within the portfolios, but you and your advisor, right? It's the advisor's role. When I take off my money manager's hat, when I take off my chief investment officer's hat, when I put on my advisor's hat, it's the advisor's role to work with the client, to work with you, to understand what your financial plan is recommending for your portfolio allocation. So again, when I put on our manager hat, we will automatically adjust those portfolios as we have been as we go through these cycles. But you need to make sure you let us know, and we'll talk more about this again at the end. You need to communicate with us how you're feeling. So again, we'll come back to that tummy test and the willingness and ability to take risk as we conclude our slide presentation today. Okay, navigating volatility, right? Steady strategies in uncertain times. So addressing tariffs and the fluctuating markets. Well, everyone knows by now we're facing turbulent markets and new tariff policies, which naturally are going to raise questions and uncertainty. And so our goal today is just to provide clarity and confidence in our approach. Now, everyone's known that these tariffs have been coming because the president's been talking about them for a long time. And, I know there's, half the people in this audience don't like the president, and I get that. And half the people in this audience like the president. I understand that too. And for those of you that do like the president, I know a lot of you don't like the way that he conducts his business. And so I have empathy and sympathy for all these groups. And my job is, to, check the politics at the door and just really try to do my job. And so I do empathize and sympathize with everybody here. But, this is what we have. And I can't control whether you like the president, don't like the president, or you like the tariffs or don't like the tariffs. So I'm not really going to address that. Again, I'm just going to stick on script and follow my processes and do what I need to do to do my job the best I can. Now, again, with the tariffs, biggest thing going on is the uncertainty around them. In of themselves, they're not that bad. The market really wasn't upset about tariffs until last Friday when they found out or it was better communicated, or it was believed to be understood that the tariffs were not going to be reciprocal and they were going to be something different. And so that again, that surprise, that unexpected event is really what caused the market to sell off. It really wasn't that there were going to be tariffs. It was the to the extent and the uncertainty that are now revolving around the tariffs. Okay, and so again, it's not what people thought. It's not what the market thought. And so it's overreacting possibly to that, or it might be underreacting. We don't know yet, and that's what's going on. There is no consensus right now amongst professionals or non-professionals about what's going on, and that's on a global stage. And so there's going to be some volatility here until we get more certainty, and so just prepare for that. Okay, now when there is more certainty with these tariffs, we would believe the markets will continue to go up and they're going to react accordingly. But we'll have to wait and see. Okay, and that's okay. We'll just continue to do our job and make adjustments as necessary. Now, tariffs are manageable within a broader context, right? So tariffs are just one piece of the global economic puzzle. And historical data shows that markets adapt to trade policy shifts over time. And we're going to look at some charts here in a few minutes. And, in my 30 years of experience, it suggests that this too will pass, but no guarantees, right? But again, we're going to look at a chart and this will pass. We just don't know how long or how severe it will be, but we will get through this. Okay. So, the politics are going to be hot and heavy. The news cycles, there's going to be a lot of, truths and untruths out there. So try to just look through the noise and don't worry about it too much, because it's just not worth worrying about. We're going to adjust things. You're going to have we're going to talk about allocations in a second. So with a good plan, we want to get you to a position where you don't have to worry. And maybe for some of you, that means raising more cash. Maybe for some of you, that means buying more annuities. For some of you, that might mean buying more stocks. And we're going to talk about that in a few minutes as well. So the chart that we have up now is the S&P 500 going back to 1930 up until April 6th. And what we're going to see here is the red lines are recessions, okay? And then I put in some of the tariff acts. So back in the 1930s, the Smoot-Hawley Tariff Act raised tariffs on 20,000 imported products. A lot of historians believe that that really aided to the Great Depression back then, as we can see here, okay? But even after that Great Depression, the markets recovered, okay? 1947, after World War II, tariffs really went away as the world was trying to rebuild from World War II. Okay, but even then, we had ups and downs in the market. So we had a nice growth period, but there's ups and downs. Again, from 1990s, tariffs were reduced. But again, as we can see here from 1960 on, there's definitely been dips where the market definitely has pullbacks, and you can see that it eventually recovers. Okay, in 2002, there were steel tariffs, but the World Trade Organization ruled them illegal in 2003. Okay, so you can see here again, they ruled them illegal at kind of the end of a recession. And so the tariffs were off and they continued to go down. In 2009, again, no one likes to talk about this politically, but President Obama, which is one of the favorite presidents for the Democrats, raised tariffs. One of the favorite presidents for the Republicans is Trump, right? So again, both parties have used tariffs, and it's okay. Again, 2018 to 2020, Trump's got tariffs. So if you want to know, you can look at this. When Obama put his tariffs on, right, on tires, Chinese tires, I believe what it was, the market continued up, and even after Trump. And so again, like I said, the tariffs are only one piece of the global economic data, right? And we really have to look at the earnings of companies, and we're going to talk about what drives the market in a few more minutes. But it's just one piece of the pie. And as you can see, there's been many ups and downs when tariffs have been reduced, when tariffs have been increased. And so again, it's really the hot item of the day, the soup du jour, and it is something serious that we need to pay attention to when we're making adjustments for. So we don't want to be cavalier with it, but I'm trying to be a little hopeful in that I'm pretty sure that this at some point will pass. Now, how long is that? I don't know, of course, but it will pass at some point, okay? And so we want to make sure that you're positioning yourself to where you're comfortable, okay? And again, we're already repositioning the portfolios to help you do that, and together we'll make sure that you get through this okay. All right, so moving on, here's just a quick summary of the tariffs, the time period, the purpose, the targets. And again, they've been around for a long time, even though a lot of people have just now recently heard about them because of the severity and the news cycle. Okay, and X and Twitter or X is now Twitter and all the news cycles, and there's so much more news availability today that a lot of people are just realizing and learning about tariffs for the first time. Okay, let's look at a quick review. So April 4th, that was last Friday. That was when the Chinese, retaliated against Trump's tariffs, and that really threw the market into a tizzy. And as you can see, it was down almost 6% for the day. 14 companies were up and 488 companies were down. Okay, so that was the breadth on the S&P 500 on a day like that. There was a few bright spots here, okay, but there was 488 companies that were actually down on that day. Now, if we look at the breadth of the S&P 500 over the first quarter, so Q1 25, so year to date, okay, the market's down almost 14%, 13.73%, but there's 131 companies that have been up and 379 companies that are down. So again, there are opportunities, within the storm, right? And so you can see here that CVS Health is up 43% and Deckers Outdoors down 47, right? So you can kind of take a minute to look through some of these companies. Some of these companies and some of these companies you may not know. But again, Coca-Cola is up, Walgreens is up, Welltower and AutoZone, McKesson, Newmont Mining. So, there's definitely some bright spots, and that's what we try to do. Now, we can't time the market and we can't pick every stock right, but we do look at this data and we do try to find the companies that are better positioned and well poised to handle the tariffs. And so we'll make adjustments. We're going to try to find, no guarantees, of course, but we're going to try to find those bright spots and navigate and negotiate into these companies that might be doing better than others. Okay. Now, again, when we look at asset classes on April 4th, there was only 11 up. These are just 173 indexes that I look at, but 11 were up and 162 were down. The one that was up, this one here is kind of like cheating because this is the direction daily S&P bearer. So this actually goes up when the market goes down. This is shorting the market. This is how we short the market. Okay, so outside of that, and I don't have all the products that short the market because that's too long of a list. And anything that was obviously shorting the market when it goes down is going to be positive. So again, there's other ways to make money in a down market. Okay, I'm just not showing all of them here. And what's interesting here, I think, is even gold right there is represented by GLD, the SPDR gold shares. Even gold was down 2.3% on April 4th. So again, it's just showing you some bright spots, although there was a lot of asset classes down, a lot of stocks down. There really wasn't very many places to hide. There were a few points of green on the screen. Okay, so, recession. Now, everyone's been talking about, is this going to lead to a recession or not? And no one knows. There's just no way to know. If, a recession, a definition of a recession really is an extended period of economic downturn. And, right now the economy's still been pretty strong. Unemployment's still pretty healthy. We're going to talk about some more factors in a few minutes. But, as of today, there was only a 30% probability based on consensus estimate from Bloomberg that there's going to be a recession over the 12 months. Now that might jump up to 40 or 50% next week, right? Or it might jump up to 80% next month. But currently, there's a 30% probability. And no one knows. We're trying to figure this out real time. So there's just so much uncertainty. Again, there's no consensus whether the market's going to go up or down, or whether these recessions are, not the recession, well, whether a recession happens or not, but whether these tariffs are permanent or temporary, or how long they'll be. And so we just don't know. It's right in the middle of that cone of confusion that I talked about in the past, right? So everything's just kind of confusing, and we're just trying to wait to see which way we come out. And so again, nobody really knows. They're going to talk about it on TV a lot because it sells, it sells magazines, it sells commercials, and it's a hot topic. But nobody on TV knows. We're just going to adjust and do the best we can as the data presents itself. Okay. So again, the other thing I want to talk about recessions is, why are we so scared of a recession? I mean, when did it become the norm that we're never going to have another recession, right? And the Fed needs to prevent a recession. I mean, recessions are healthy. For any gardeners in the audience, you know that pruning your fruit trees bears more fruit, right? So think about that again. Pruning your trees can bear more fruit. Okay. So a great reset is going to provide great growth at the back end of that. And so, yeah, we might go through some pain, and I think we need to go through some pain. I think that, again, this is healthy. I don't think it's healthy to just never have a cycle again. And so I don't like recessions. I don't want recessions per se. I don't want to see markets go down or people lose money. And so we're not trying to be cavalier with that, but from the economic perspective, it is healthy for things to cycle, and it usually means rebirth or new birth, right? So if we are all the way down here at a new low, what comes up is the next part of the cycle, which is great growth. Okay. So where are we? Well, I don't know, but my best guess is that we're kind of on this red line where we've been trying to, have that soft landing and skirt a new low. Okay. So I think the economy's doing pretty well. Unemployment's pretty well. Really, inflation and interest rates are okay. Corporate earnings are okay. And those things are going to change with a longer duration of the tariffs. But they're at the moment, they're not bad. And that's been holding economic growth up. But we are this arrow coming down. We really could start testing new lows if these tariffs do kick us into a recession. Then we're going to move back down towards this new low, and then at some point we're going to extend back up. So again, I just want to point out here that an economic cycle is healthy, and although nobody likes the bottom, we can try to prepare for it. And if you've got a diversified portfolio and a diversified financial plan, and you're integrated, right? Your financial plan and your investment policy statement are integrated. Well, that's going to be your best protection to ride, through these cycles. Again, we can't prevent them. I don't think that's healthy. I don't think the Fed should try to prevent the cycle. But what we can do is reposition ourselves as we go through cycles. So again, I don't control the cycle. I wish I did. But from the last 30 years I've been doing this, the markets and the economy cycle, and there will be a recovery. It just doesn't seem like it on the way down, and it doesn't seem like it here. Remember, I've talked a lot about the emotional cycle, right? And so, as Buffett once said, you need to buy when people are fearful and sell when they're greedy. And so, again, up here, you're feeling really good. Everything's gone up. And this is not when you really want to start moving the cash, but that's really when you should be doing that. So, again, we know that most people buy high and sell low because of that emotional cycle, which is inverse to the true economic cycle. So, again, back down here when it gets really, really bad, that's probably a time to buy, and we'll talk more about that in a few minutes. Then, when we look at what drives the market, remember we talked about interest rates, inflation, corporate earnings, and the Fed, and then the fifth one's the geopolitical events. And that's really what's driving the market right now is the geopolitical events revolving around tariffs and the uncertainty. And so, yeah, we're looking at this bear market right now. A bear market corrections around 10%. A bear market's 20. So we're moving into that bear market very rapidly. The last couple of days in the market have been historical downturns. So a very rapid decline here, entering that bear market territory. But again, just like the economic cycle with the market cycle, at some point there's going to be so much value remaining and so many opportunities that money will come back in. The supply will be there, and the equilibrium between supply and demand will be found again, and we'll recover, and we'll go back into an expansion. Okay, so interest rates are coming, or the 10 years coming down a little bit because of that flight to quality, and the inflation could temporarily go up. But one thing on inflation, this time around, a lot of us believe that this is going to be a demand issue, not a supply issue. Coming through COVID, there was a lot of inflation because we all had $100, and there's 10 of us have $100, and we're all trying to buy a banana, and there's only one banana, and so we bid it up, right? Everyone has a few dollars, but there's only one roll of toilet paper at Costco, and we're all fighting for it, and so it really drove those prices up. When we talk about demand, if prices of these tariffs cause a T-shirt to go from $5 to $20, you're just not going to buy that T-shirt, and that's why looking at these, the discretionary sector and avoiding that might be good, right? So this is going to be really a demand is not going to be there where there's plenty of supply, but nobody wants to pay $20,000 for a bicycle. So again, this time around, it's probably going to be the demand side that we need to be worried about, not the supply side like we came out of COVID. So again, inflation can come from the demand side or the supply side, and this time we think it's going to be coming from the demand side. So if it does come from the demand side, that can actually put a downward pressure on prices eventually, because if nobody is buying the t-shirts, the company's going to have to reduce the price and reduce their margins and take lower profit in hopes of selling t-shirts. And so again, that's not good for earnings, right? It's not good for profit margins. But as far as inflation goes, that's the counterbalance. Remember, there's always an equal and opposite reaction to something according to Newton. And so if we're looking for a bright spot, that might be one of them, is that it's going to be a demand side of the inflation, and the consumer, you can control that by changing your spending habits. Okay, so there's some cycles, and again, cycles are natural, and they're just tough to go through, and they're not fun, but again, they've always recovered. So we just don't know when and how long or how deep it will be, but there is hope that it will recover, and it will not be the end of the world. Okay, what do I do? So, what should you do? Well, remember, there's no perfect investment, right? And so, first of all, we have to start off with your portfolio goals. And the goals are really to ride the bulls, right? When the markets are going up, is to optimize the upside capture, right? And participate in some of that up. And then tame the bears. And so that's minimize downside capture. Now, the reason that I've highlighted minimize downside capture in red is because I think a lot of people think that minimize means avoiding all downturns, and it doesn't. If the market's down 10 and you're down 5, that's good. If the market's down 20 and you're down 10, that's good. So taming the bears does not necessarily mean that there is no downside capture. It's minimizing it against the alternatives. Okay, so I want to make sure you understand that the difference is there. And then again, what we're trying to do is we're trying to build better diversified portfolios that have reasonable returns with reasonable risk over reasonable time periods. And we're going to talk more about those time periods in a few minutes. So again, looking at that perfect investment, we have to start off looking at the reality of the goals. Okay. So the next part is to double check your allocation, right? So when it comes to that perfect investment, you can usually get liquidity with protection. You can get some protection with a little bit of returns, and then you can get returns with liquidity. And so, each kind of sleeve there provides something different. So in that liquidity sleeve, you need to be looking at cash and CDs, right? In the protection side of things, you can look at annuities and T-bills and structured notes. And then when it comes to gains, that's where we look at risk on assets or risk on strategies. And predominantly people think equities when they think about, gains, and the things that can go up, but they can also go down. And so having a nice allocated portfolio where you have a proper amount of liquidity, protection, and gains in your portfolio is really your parachute. That's really what you need to be looking at, and let the equities do what they're supposed to do. Now, I want to expand on this section here. And the reason the dividends are in green is because out of the equities growth, right? We've been seeing things rotate out of growth, and the value and dividends have been in favor, and dividends are still positive for the year. We were positive on our value portfolios up until last week, but again, dividends are still positive. But I want to talk about this gain for a second, because I'm getting a lot of questions, right? What should I do? What should I do? And there's two schools of thoughts, right? So we go back to our coins. There's two sides to the argument. So on one side of the coin, we have people that want to sell their stocks. They're worried about this bear market. They want to protect their money. They want to get more green money. They want more cash and equivalents or annuities, right? And that's probably about 50% of you. And then there's 50% of you that are calling me up and saying, buy, buy, buy. Now, you may not be, some of the people that want to buy are wanting to buy these growth stocks that are down the most, that have really been hit the hardest, because they perceive there's more value there, right? So some of you are really wanting to go into that growth. Others of you are wanting value in dividends, okay, because they are what's working right now. So in that equity stock section, there's some of the stocks that are really beaten down, and they might provide great opportunity. And then there's other stocks that are less beaten down and that are performing better right now. And so a mix of those might be good. So again, we have to ask you, what is your time horizon? If your time horizon is the next 3 months or 5 months, yeah, you should not be in equity, right? And you really need to recheck your allocation and what goes into that perfect investment. And if you're younger, or if if your time horizon is 3, 5, 10 years, well, you're probably more happy to buy stocks right now. And so it's not, the answer of what to do isn't the same for everybody. It's really, who you are, where you're at in life, and what's your tummy test, right? What's your willingness and ability to take risk? And that will determine, should you be selling or buying. Now, remember, within the portfolios, we're already going to do the buying and selling for you as far as that goes. This is really talking about that perfect investment and you allocating amongst, the cash, or, the cash and the protection and the equities. And that's why we're talking here is just that subsection of the gains, the return section. Okay. So again, I know a lot of people that want to go to sell all their stocks and go to cash, and I know a lot of people that are trying to find every penny they can to buy stocks. Okay, so the for some the glass is half full, and for some it's half empty, and that's just where we're at right now. So just to give you an example, this is strictly a hypothetical example for education purposes. It doesn't represent any particular investment and it's not investable. It's just again, a slide I want to walk through to show you, put things in perspective for you so you can have a better understanding of who you are as an investor and have a better sense of your willingness and ability to take risk. And so in this example, we put 50% of our money into a risk off strategy that can do 4% on the upside, but can never go down. And then we took the other 50% of our money, okay, we took the other 50% of our money here and we put it into something that might go up 7 in a bull market, but then might go down 20 in a bear market, okay? So if you have 50%, if the market goes up and you have 50% of something that does 4, it's 2, and you have 50% of something that does 7, that's 3.5. And so this weighting 50-50 will give you an expected portfolio return of 5.5%. Now on the downside, if you had 50% of something that did 0, that contributes 0 to the portfolio. And if you had 50% of something that did -20, you're only down 10. Okay, so in this case, on an up market, you're up 5.5, and in a down market, you're down 10. Now, from doing a lot of asset allocation work over the years and running thousands and thousands and millions of Monte Carlo simulations, I would guess, in my opinion only, that this portfolio 90% of the time would be down about 10 and up about 20 and on average 5.5. So I think these numbers are pretty realistic. So again, the market's down, 13% for the total year. So if you had 50% of your money in the S&P, let's just say you're down about 7 with rounding, okay? And if you had 50% of your money in an annuity, you're down 0. So again, your portfolio's down 7%, and 7% looks a lot better than being down 14. And again, that is what risk mitigation is about. The only way to obviously eliminate all potential loss from the market is to be in all cash CDs or annuities. Okay, but this seems to be a very nice balanced blend. And I think right now, for a moderate investor, I think being 50% in fixed income is great. We might have 25% in T-bill model, 25% in the focused bond model. And then on the equity side, I would probably do 25% in the focused tactical equity and 25% in the dividend portfolio. Now, again, those aren't recommendations. Those are just highlights to illustrate this slide. For your own recommendations, you need to sit down, okay, with us and look at your willingness and ability to take risk. Each of you has your own situation and your own allocation that's going to be right for you. And as many of you know, we represent that in what we call a lifestyle return benchmark. Okay, I'm not going to talk about that today, but again, in this video, we're not giving any specific advice. We can't do that at this level. To give fiduciary advice, we have to sit down with you one-on-one and look at your individual facts and circumstances. Okay, but this again is just, don't forget that if you're running a strategy like this, that even though the market's down 7, if you were down, if you only have 50% in the market, then you're down much less than the market. Okay. Now you could be down more than the market, right? You could be in a risk on investment that is down much more. And there are many people that are down much more than the market. Okay. So again, that potential exists as well. Okay. So again, what should you do? Well, hold enough cash to make you comfortable. Evaluate your time horizon, very important, and other factors, remember, of your investment policy statement. And then communicate your changes in your objectives and constraints so that we can adjust your portfolio allocations as necessary. And again, together as a team, we're going to get you to where you want to go. Most of all, you got to be patient, right? I know it sounds and feels like the world's coming to an end. And I don't think so. I sure hope not. I don't believe, based on history, that it's coming to an end. And we're going to have some pain for a while, but it will recover, in my opinion. And so somebody asked me the other day, well, Joe, how do you feel about this? How do you feel about that? And I said, if I manage money based on my feelings, we'd all be broke. So again, I'm not going to manage this money for you based on feelings. I'm going to base it on the data that keeps changing and processes that have worked well for us for 30 years, and we're going to keep you on track. So again, be patient, stay calm, remember to communicate, and this will pass, and we'll get you through it. And someday, we'll look back and go, wow, those were some difficult times, but we survived. So with that, I want to thank you. Of course, please read our disclosures. I'll give you a second to do that. It's very important to understand the context of this presentation, that we're not giving fiduciary advice. We're giving you our opinions and summarizing what's been going on. And again, we invite you to have one-on-one conversations with us about your particular situation. We look forward to hearing from you. We want to thank you so much for the opportunity that you give us to serve you, and we will do our best job possible. Again, it is Sunday night, probably it's still about 11 o'clock on the West Coast time. I'm still up looking at this. I'm not sleeping much nowadays, but we're working hard to get through it. And it's a pleasure. It's a gift from God to be able to serve you. It's a gift from God that I like to do this. And so thank you again very much. And I appreciate your time today. Thank you. Good night. Or good day if some of you are getting this for the morning. But anyway, we'll talk to you soon.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.